The S&P 500 has recently hit an all-time high. A major contributor to this has been the big five tech companies, who make up almost 25% of the index. Their share price and market capitalization have reached record highs in 2020, despite the global recession, and they continue to report impressive revenue figures and compounding growth. With their prices at these levels, do you invest now and risk buying the stock at its peak, or wait for a potential reduction in price that may never happen and risk losing out on big returns? Well, in this short series of videos, we'll be completing an analysis of the big five tech companies, and we'll offer some insights to help you make a decision on whether to invest now or wait. So let's first compare Amazon and Google on today's investment store. Welcome to the Investment Store,
the personal finance channel where we review a diverse range of investment asset classes, from stocks and ETFs to real estate and cryptocurrencies. If you enjoy this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video.
At the Investment Store, we generally follow value investing principles that are followed by some of the most successful investors in history. Having said that, we also pay close attention to growth stocks that show genuine promise of sustainable long-term returns. When analyzing growth stocks, economic moat is essential. You've probably heard the expression that the three most important factors in purchasing real estate are location, location, location. Well, I would argue that the most important factors when analyzing and purchasing a growth stock are moat, moat, moat. This is because the share price of a tech stock is typically based on growth assumptions that are linked to how well the company uses its economic moat to increase market share. A wide economic moat can lead to long-term margin expansion, accelerated growth, and exponential returns for investors. This has been demonstrated to perfection by the big five tech firms. It's more likely that tech companies with a narrow moat will fail to achieve their long-term growth projections due to fierce competition, and their share price can crash as a result of this, along with your investment. Therefore, it's imperative that we take the time to really understand an organization's business model, roadmap, and the market forces that will affect these. With that said, let's commence with the analysis. At the Investment Store, we take a four-step approach to analyzing stocks. We first analyze whether a company has any form of economic moat that gives it a competitive advantage. Next, we assess the organization's financials by taking a look at their financial statements and key investment ratios. We then compare the stock with other companies and investment funds in the same sector to assess how they're performing in their market. And finally, we calculate the intrinsic value of the stock to see whether it's trading below its fair value. Once we've completed all those four steps, we will generate the Investment Store score. So without further ado, let's look at the economic moat for both Amazon and Google. Now, for those that are new to this channel, we review economic moats in the following five areas. Intangible aspect, which considers whether they have a brand that gives them a competitive advantage. Switching costs, are their customers tied due to high switching costs or inconvenience of switching services? Cost leader, are they a profit or loss leader? Network effect, do they have an ecosystem in place that continues to generate multiple sources of revenue? And finally, scalability. From an intangible aspect perspective, Amazon and Google are market leaders in e-commerce and search services, respectively, and they have built their brands by delivering breadth, efficiency, affordability, and quality in these areas. We believe that Amazon has more competition in their space than Google. So we've scored Amazon a 9 out of 10 and Google a 10 out of 10. In terms of switching costs or switching services, both Amazon and Google have successfully managed to gain a clear advantage over their competitors by retaining users and limiting customer churn rates. Both companies have successfully applied hidden revenue business models which strategically keep consumers reliant on their services over the long term. This is a very powerful business model, and during this series of videos you'll discover that most successful tech firms have adopted this strategy. We've scored Amazon an 8 out of 10 here, as although it is a market leader in most of its service verticals, it still faces credible competition from the likes of Alibaba, eBay, and Microsoft. In contrast, Google is a dominant player in most of its markets, controlling 80% of the search engine market and 85% of the mobile phone operating system market. And for this reason, we've scored Google Alphabet a 10 out of 10. Next, considering cost effect, both Amazon and Google have created an environment where consumers can obtain goods and services at competitive prices. They have also created an ecosystem where users become reliant on their services as their own main source of income. Their combination of competitive pricing, unparalleled logistics capabilities, speed, reliability, and good customer service enables both companies to expand their market dominance in this area. So we've scored both businesses a 9 out of 10 here. For network effect, Amazon and Google both use their platforms to create an internal ecosystem of buyers and sellers. As we noted under the switching costs aspect, this business model is extremely powerful as the rate of participation and quality of service is increased with every new user that joins the platform. Both companies have mastered the execution of strong network effect in their business models, so we've scored them both a 10 out of 10 in this area. Finally, in terms of scalability, Amazon has more than 500 million global active users, with almost 170 million subscribers for its Prime service. Amazon are expanding their market share into new territories and have demonstrated this through their expansion of Amazon Web Services, which currently has a compounded annual growth rate of 25%. Google are also expanding into new areas, such as autonomous car technologies, and this is expected to be a multi-billion-dollar industry within the next 10 to 15 years, and will naturally increase their market dominance further. So we've scored both companies a 10 out of 10 in this area. This gives Amazon an overall moat score of 9 out of 10, and Alphabet a score of 10 out of 10. Moving on to fundamental analysis, we will now review each company's key financial data. Amazon's operating and net margins have been increasing steadily over the past 10 years. However, their margins are low when compared to other companies with a wide economic moat. Now, this is mainly attributed to the fact that Amazon invests heavily in research and development, which means they have high operational expenses. Their margins are also increasing, as we can see from the Q2 results. Taking this all into consideration, we've scored operating margin and net margin 6 out of 10. For return on asset, we like to see a return on asset value greater than 10% for a growth stock and a return on capital employed value greater than 15%. Amazon falls below this in both areas. However, the numbers are increasing, so again we've scored this a 6 out of 10. When we look at debt to equity, Amazon's debt to equity ratio is over 2.5 over the past 5 years and has been as high as 5 over the last 10 years. Again, this reflects their high level of investment in research and development. However, it's higher than we are comfortable with, so we've scored this a 4 out of 10. The price to earnings growth ratio, or PEG ratio, is a very important ratio to use when analyzing growth stocks and tech companies. PEG measures how a company is priced relative to the rate of earnings growth. This is a far better indication of how cheap or expensive a stock is as opposed to using a price to earnings ratio. The lower the number, the cheaper the stock, with a PEG less than 1 being the optimal value. When we look at Amazon's PEG ratio, we can see that it's been as low as 0.39 in 2018, but it has gone up to 5.3, and currently during Q2 of this year stands at 8.29. This suggests that the stock is overpriced in relation to its rate of growth, so we have scored this a 3 out of 10. Next, we'll move on to free cash flow yield. The free cash flow yield gives an indication of how a stock is priced in relation to its cash performance. The higher the number, the better. And for a growth stock, a score above 3 is ideal, as it means the company is generating lots of cash. Again, this is another sign of a wide economic moat, so we like to verify this with our moat analysis. Amazon has a healthy free cash flow yield, which is increasing year on year, so we've scored this a 7 out of 10. Finally, when we look at the annual growth rate, Amazon has experienced big swings in its growth rates over the past 5 years. We can see that its growth rates in operating income have been over 200% in 2 out of the past 5 years, which is phenomenal. For their Q2 results, they have achieved a growth rate of 107% in terms of operating income. And this is largely attributed to the global lockdowns and consumers being reliant on online services. These are impressive growth levels, and we've scored this a 9 out of 10. And the only reason it's not a 10 out of 10 is due to the negative growth that the company experienced in 2015. Taking all of this into consideration, we have given Amazon a fundamental analysis score of 6 out of 10. Moving on to Google's fundamental analysis. Google's operating and net margin has been consistently over 20% for most of the past 10 years, which is a typical sign of a company with a wide economic moat. We've scored both of these a 9 out of 10, as the margin levels have been decreasing slightly in recent years, and this was also reflected in their recent Q2 results. Nevertheless, these are still impressive numbers. For return on asset, for growth stock, as mentioned earlier, we like to see this value above 10%, and Google have achieved double figures in 4 out of the past 5 years, so we have scored this a 9 out of 10. For return on capital employed, for growth stock, 15% and above is our target, and Google have managed to exceed this level once over the past 5 years. So we've scored this 8 out of 10. Google's debt to equity has been increasing slightly. However, a debt to equity of less than 0.5 is exceptional, particularly for growth stock. And Google have remained consistently above this level for over 10 years. So we've scored this a 10 out of 10. When we look at the PEG ratio, we can see that Google's PEG went down to 0.2 in 2018. Which means that it was undervalued along with most other big tech stocks during 2018. It is now up to 2.06, so we've scored this a 7 out of 10. For free cash flow yield, a number consistently above 3% is ideal for a growth stock. Google have achieved a free cash flow yield above 3% in 4 out of 5 years, so we've scored this an 8 out of 10. And finally, when we look at the annual growth rate for Google, we see that it's currently at a level of 14.5%, but has been reducing slightly since 2016, which is a slight concern, so we've scored this a 6 out of 10. Taking all of this into consideration, we score Alphabet Google an overall fundamental analysis score of 9 out of 10. We will now compare Amazon and Google against each other and with some of the leading sector ETFs, such as the Invesco QQQ Trust and SPDR Technology Fund. This will help us to assess whether our money is better invested in the stock or in an ETF. Google has a far superior margin than Amazon, so we've scored them a 9 out of 10 for net margin and Amazon a modest 5 out of 10. Next, we'll look at the PE ratio. Now, whilst we recognize that the PE ratio is not really relevant when analyzing a growth stock, it's still useful to compare its performance with ETFs. So we can see that Amazon has a very high PE ratio of 143, whereas Google's is in the same range as the sector ETFs and is actually the lowest of the four. Therefore, we score Amazon a 2 in this area and Google an 8 out of 10. Looking at the PEG ratio, Amazon's PEG is very high when compared to Google's, so we've scored Amazon a 2 and Google a 7 out of 10. Neither company pays shareholder dividends, so we won't score this particular area. But what's interesting to take notice of here is that both the ETFs do pay dividends, so it's something that we would consider if we're making an investment decision. Moving on to the cash ratio, which is the ratio of cash equivalents to liabilities, and effectively the higher this number, the better. Amazon are stronger in this area than Google, so we've scored Amazon an 8 out of 10 and Google a 4 out of 10 for cash ratio. For return on capital employed, we've scored a 6 out of 10 for Amazon and 8 out of 10 for Google. And for price to book ratio, although this is not a parameter that is very relevant for growth stocks, we use it for comparison with the ETFs, similar to PE ratio. And we noticed that Amazon have a very high price to book ratio, but actually Google's is lower than the ETF sector average. So for this, we've scored Amazon a 2 out of 10 and Google a 9 out of 10. Moving on to debt to equity, as per the financial analysis or fundamental analysis section, we've scored Amazon 3 out of 10 and Google a 10 out of 10. And then finally, when we consider the 12-month price difference in share price, both Amazon and Google's price increase is less than the ETFs, with Google below by some margin. So we score Amazon a 7 out of 10 here and Google a 5 out of 10. This gives Amazon a comparison score of 5 out of 10 and Alphabet Google a score of 7 out of 10. The next step in our analysis is to determine the intrinsic value of the stock. At the investment store, we use a discounted cash flow method and Gordon growth model to estimate the value of an investment based on a company's future cash flows. Using an annual growth rate of 20%, we calculate an intrinsic share price value for Amazon of $1,150 per share. Now, at the time of making this video, Amazon's share price is approximately $3,440. Amazon would need to achieve an annual growth rate of 33% to justify this price. Now, the 5-year average growth rate for Amazon currently stands at 45%. If we were to use this number as a growth rate to calculate the intrinsic value, we would get an intrinsic value of $7,715 per share, which is double the current share price. Now, when it comes to analyzing the growth rate of a stock, no one can guarantee what the rate of growth is going to be. So it's important, if you're serious about buying this stock, to do your research, understand that economic moat, as we discussed earlier, to see whether this growth rate is realistic. Now, if you believe the growth rate to be a realistic one, then it could be that the price is actually trading below its fair value. So with this in mind, we score Amazon an intrinsic value score of 6 out of 10. Now for Google, If we apply an annual growth rate of 20%, we get an intrinsic value of $1,588 per share, which is in the range of their current share price that currently sits at about $1,630 per share. Now, if we were to use Google's 5-year growth average of 26%, the intrinsic value would be $2,550 per share. Again, if you are planning to purchase this stock, you would need to make an assumption on what this growth rate could be. We believe that Google can actually achieve an annual growth rate of 20%. So this would mean that its current share price is in the range of its fair value. And therefore, we give Google an intrinsic value score of 8 out of 10. So in summary, we have recorded the following scores for Amazon and Alphabet, giving them an ISS of 6 out of 10 and 9 out of 10 respectively. There's no question that these are both great companies with sound economics. However, if we were to make an investment in either of these companies, we would need to consider whether a sector-specific ETF would be a better option, particularly when we consider the potential of having greater annual returns, lower risk, and a dividend payment as well. Another option would be for us to continue monitoring the share price and wait until it's trading at a lower price that offers a greater margin of safety with our investment. A question for you: what growth rate would you apply to Amazon and Alphabet, and why? Please leave your response in the comments below. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyze assets, please subscribe to the channel. We look forward to seeing you on the next video.